You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call around here the Old Options Insider Radio Network, OIRN for short. If you don't have time, you're into the acronym game. And of course, where can you find all of our fun episodes of the OIRN, as well as all of the fun archived episodes of Volatility Views, well over 100 of them now. Of course, you find them on the mothership, the website, theoptionsinsider.com. Surf on over, click on the Insider Radio Network tab. It's on the top left there, listeners. You get access to all of that goodness. Of course, surf on over to iTunes, Stitcher, Aha Mobile, TuneIn, a few others I'm sure I'm forgetting there. Pretty much wherever you find your programs of choice. Or, of course, just take that RSS feed. We can make it out there for you, available for you on the landing page of the show, and just paste it into whatever podcatcher you prefer. You can get our shows however you like. And a lot of you like to tune in on Bar Chart as well. There's displayed and featured and run over there as well. No shortage of places, as well as all of our partners on the network feature our programs as well. So there are a legion, a myriad, if you will, of places you guys can access the content. And we're very happy that you do just that. And of course, while you're doing that, make sure you send us some questions, some comments. We love to hear from you guys as well. And joining me on the old program today, the old Vol Views program, starting off with the man beaming in from snow-covered New York City. You don't say that too often. Mr. Jared Woodard from BGC Partners. Jared, welcome back to the program, sir.
Hey, thanks. I'm glad to be with you.
So you've survived cross-country skiing to work these past couple of weeks?
Well, I had to trade in for ice skates, but we're getting it done.
I was talking to someone the other day out in New York, and he was saying that essentially getting to that point where the snow is just so piled up that you can cross at like one or two designated spots every few blocks, wherever someone has had the wherewithal to carve a path in the snow. So everyone's following the same path up and down the street like some sort of weird caterpillar. Kind of funny.
Yeah, it's pretty clear downtown, but certainly up in the suburbs, you get that kind of tunneling effect. And I have friends in New Jersey who are talking about the river freezing over on the right end today. So it's really exciting times.
Yeah, we certainly have some of that in Chicago here with the river freezing over. And the man, of course, who knows naught but snow, beaming in from the hinterlands of Maine, the rock lobster himself, Mr. Andrew Giovinazzi from the Pit, as well as a few other programs on the old Options Insider Radio Network. Mr. Giovinazzi, glad you could join us, tunneling out from amidst all of those, 300 feet of snow you have now in Maine?
It's starting to feel like that. It's at least 5 feet around here. and areas.
It's getting pretty hefty up there. So before he gets covered over, listeners, let's keep on rolling with the show right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that funky tune means it is time once again for the Volatility Review. This is the segment of the show where we look back on the week that was from a volatility trading and analysis perspective. And compared to some of the other weeks we've had, this is not the most active week from a vol perspective. I'm looking in VIX Cash land. We're actually recording this, I should mention, listeners, Friday, February 20th, right around 1 p.m. Central here. So midday now, markets on a bit of a low rally streak. So going into the weekend and the markets rallying, we're seeing vol come in yet again. So we've hit new lows for the week from a VIX Cash perspective, right around 14.9 right now. We had a high a little bit south of 17, about 16 in the orders or so this week from a VIX Cash perspective. So compared to recent weeks and the ranges we've seen from an implied volatility perspective and the intraday movements we've seen from an implied volatility perspective, this certainly is not the most gang-buster of weeks. Looking out over at our friend the S&P, seeing that their about 30-day implied is hovering right around a 13, so a little bit of a premium between VIX Cash and 30-day implied, as there typically is these days, given all the other myriad things that go into that VIX calculation. Looking at the 30-day historical out here in the old S&P, hovering right around a 15, so we're pretty much at parity from at least a VIX Cash versus 30-day historical. Of course, we've had myriad conversations of late of the kind of inherent fallacies of comparing those two, because one's a 30-day backward-looking indicator, one's a 30-day forward-looking indicator, and what you have to do from a logical and an equation perspective to make those two really size up and be able to be compared to each other. Maybe we'll get into that again. Maybe there's some more listener questions on that today, but an endless topic. We can debate it ad nauseum here on the old program, and of course, hovering right around about where we were last time from a skew perspective, looking at about a 131 out there in SIBO skew land. And since you haven't been on in a while, actually neither of you have been on in a while, so maybe we'll start with the man who's the most buried in snow, which would be Mr. Andrew. What caught your eye from this relatively quiet week from a vol perspective?
Well, there's the two key things for me. One is where the VIX futures were relative to the cash, which were quite, I thought, we haven't seen that near-term premium that high in a while. And I believe right now it's starting to drift a little bit lower. We have VIX in the 14 handles. So basically what was happening is waiting for this thing in Greece to settle. VIX future premium started building into the March contract, got a little bid, kept the volatility products a little bit bid. And it looks like there might be a settlement here coming into the weekend. So they're taking some air out of the VIX. And some air is coming out of the volatility products as well. So it looks like we're getting a little weekend effect, and we're actually getting a markdown in vol, pretty solid markdown in vol as well. So an interesting, let's just call it, we could see, if I think the Greece thing goes the way, we could see the vol really take a pretty serious dive.
Yeah, Fed seems like it's kind of off the table in the near term, at least punted the ball a little bit there. Seems like Greece maybe getting underhand. Maybe that's a little bit optimistic, but certainly seems like the market is leaning that way. So if we do see Greece finally come off the table, really at this point we're towards the end of earnings season. Yeah, you're right. What's left to really inject some juice into the marketplace for the near term? I don't see a heck of a lot, do you?
Right. It would definitely have to be a left field thing, and that future premium is, like I said, it had built in $2.50 on the close yesterday. I'm starting to see it come in today, and you could say sayonara to some of the volatility products, and that's how I thought the market's been pricing. And again, the Dow's making an all-time high, the S&P 500 ticking away from that 2100 handle. So woo, put your rally hats on and off we go.
Yeah, we're off to the races now. And Mr. Jared, it's been a couple of weeks now. What's been catching your eye from a vol perspective over there at BGC Partners?
Yeah, you guys you're not wrong. It's been really quiet and too quiet. No, I mean, it's been as quiet as you'd expect given what's been happening. Earnings weren't, the disaster that I think some folks might have been expecting after weaker retail numbers for December. And overall, yeah, I mean, one thing that stood out to me in some of these earnings calls was folks blaming things like the strong dollar or the Swiss franc or it's kind of like the excuses change every quarter sometimes, I think. But overall, earnings were on average kind of surprised a little bit in terms of actual EPS versus forecast levels. There was some upside there, small but real. And so yeah, there's just not a lot of catalysts, I think, in the short term. I think a lot of participants have been immunized against the kind of TikTok headline process as negotiations continue in Europe, and so there's been less reactivity than we saw in years past. And for the near term, I think one thing that's going to be worth watching is what the economic data says about January, and as we start to get indicators for February, because I know that there's been a lot of disappointments, whether it's durable goods or retail sales or PMIs or other kinds of indicators that have come in much lower than expected. And a lot of analysts who have dug into the guts of these releases have found that there's some seasonal adjustment methodology that can give you a very different outcome depending on how you approach it. There's just the fact that cold weather has kept people at home or kept people out of stores or kept people not doing the things that they might normally otherwise do. And so, I think that as we turn towards the spring, we might see upside volatility and actual upside risk in terms of deviation from this very quiet mean that we've established, and that could be driven by better than expected economic data for the U.S.
Thank you for that, Mr. Jared. And of course, from the week that was, from a vol products perspective, it wasn't a terrible week. It wasn't a gangbusters week. We actually saw some decent volume, certainly compared to the last few weeks where the volume was comparatively anemic. We saw some decent volume this week, with exception of yesterday, the 19th, where we only saw about 250,000 contracts going up in products. The big motherships like VIX and others wasn't really lighting up the tape yesterday. Today we're doing about that level. We actually already surpassed that so far today. Interesting is we're seeing good spikes in VIX on upside days, which traditionally hasn't been the case. VIX, of course, always a downside biased product by the nature of the marketplace. So to seeing VIX doing decent volume on upside days is kind of interesting in and of itself. But overall, the open interest is still really, really anemic out there. We're looking at the hot strikes where the quote-unquote action was for the past week, and the number one spot on the hot list, the hot top 10, wouldn't even probably be number 10 in most other scenarios. We're seeing the March 30 calls. So seriously optimistic calls, lighting it up to the tune of 133,000 contracts, taking over the number one spot. Number two, the puts coming in the March 16 puts. So a nice little strangle on there. March 30, 15 strangle for 122,000 contracts. Then we got the number three spot, 18 calls in March for 118,000 contracts. Then the 20s for 113,000. Then everything else is pretty much south of 100,000 contracts. March 25s and March 27s with about 95,000 each respectively. March 18 puts coming in number 7 with 91,000. The March 23 calls with 83,000, and the March 15 puts 81,000, and rounding out the top 10, the March 17 puts with a whopping 71,000 contracts. So overall, the open interest has fallen off a bit of a cliff, with open interest here at about 3.4 million contracts, about 2.3 on the calls, and about 1.06 million on the puts. Compare that to an average of somewhere around probably 5 to 5.5 million usually open out there, and you see that things are still relatively anemic. People are waiting, of course, for those extended hours to kick in a couple of weeks on March 7th to see if the VIX options really start taking off, or if indeed, like we said before, if the Greece stuff is going to be settled and some of the other big issues kind of floating around, like the Fed have been punted. Maybe no one needs any more vol products for the near term, at least any more hours to trade these vol products, because they're certainly not really lighting it up during the given sessions they have right now. Some of the other products we've, of course, been scratching our head about for a while continue to puzzle us, including VXST with a whopping 200 contracts open. That's better than last time. I think they had 3 open last time, something along those lines. And RVX, their old Russell volatility, still hovering around a 22 contract open interest. I know there's things have kind of been, seem like they've been quiet a little bit out there. Of course, the acquisition of Russell by the London Stock Exchange and a few other things have always, M&A always throws a wrench into the works, and you're talking about developing new products. And so I think now that is pretty much finalized in the rearview mirror, they can kind of get to work pumping RVX out there, as well as some other cool products I know they have in the pipeline coming down the pike over there at Russell. And Mr. Jared, I know you like to watch volatility, not just domestically, but what's cooking internationally as well. Anything really catch your eye out there from an international vol perspective?
One thing that is worth thinking about is the disparity that's become fairly clear between global demand. You've got emerging markets that have cooled, developed markets outside of the U.S. that are all struggling to generate, strong consumption, versus the U.S. where the consumer is just like the kind of the workhorse of the global economy, pulling everyone else along. And right now, there's actually a kind of a counterintuitive situation in vol. With the flip side of that, you might think that, with the U.S. consumer doing all this work and the rest of the world, struggling a bit, that you might expect, say high put skew, for example, in the indexes of these other countries. What's counterintuitive is a little bit surprising right now is that it's exactly the opposite. The implied vol skew for downside puts, say 25 delta or so in the U.S., to some extent in Europe, Euro Stoxx 50, at some extent in the Nikkei, but not as much, is relatively high. Emerging markets like the Hang Seng in China, in Hong Kong, and other kind of major liquid emerging markets aren't actually quite as expensive, which is a little bit surprising to me, I think, if you approach it from the economic angle. But with that in place, I mean, this is continuing a trend we've seen for several weeks now, really this whole year almost, where you've had really expensive downside puts in skew terms, obviously not nominally or kind of an absolute basis, but they are relatively expensive. And so that's been driving a lot of interesting trades, both across countries and even within countries where, other ways of, given that hedges are more expensive now, it creates a sort of new form of demand for more effective, more cost-effective tail risk hedges. And especially if you're worried about emerging markets, you're worried about an adverse scenario in Europe, there's some interesting relative value trades, I think, to be done in these circumstances across borders.
Definitely concur with that latter sentiment, sir. A lot of interesting stuff cooking out there in an international perspective as well. Of course, I didn't mention here at the top of the show, getting back to domestic for a second, that of course we did have expiration on the VIX side of the fence this week as well. Of course, that is the primary reason why the open interest has fallen to such anemic and some may say pathetic levels, but we usually see this cycle, things come off, the expiration, the contracts go away. We see people reestablishing in the March timeframe. We'll see how long that takes this time, if, like we said, all the other indicators perhaps being a little bit light, if perhaps people won't be reestablishing their contracts and positions anytime soon. We'll see how the top 10 shapes up into the weeks to come. Mr. Andrew, anything really surprised you about the whole VIX expiration this month, or was it pretty much par for the course?
It actually is one of the ones I remember that didn't close too far away from the closing price on Tuesday.
Yeah, last month I know people were very upset about that. They printed it at almost 21, and immediately it was trading like 4 or 5 handles lower the next day. This one not as controversial.
That was a hoserama. This one, I believe, around 25 cents off the Tuesday close, so not too bad. But as far as VIX goes, where I'm watching the volatility implode as we speak, of course, everybody's going to hear this on Monday, but they're liking some Greek. That's been a drum we've been beating at Option Pit. If the Greek thing settles, the vol's going to come in, and we're going to see the 14 handle or lower, and lo and behold, here we are. And as Jared alluded to, waiting to see if some of the downside skew could come in. This could be a kind of a big compression and all that stuff. So, it's been a while. Maybe we could see. I'm not going to start it's not crystal ball time yet, so I'm going to keep the listeners in suspense. But as far as VIX goes, I expect to see implied vol of VIX come in pretty substantially over the next couple of days.
And let's move beyond the domestic, beyond the equity and index land into the product category that certainly has been top of mind for a lot of listeners from a vol and underlying movement perspective, certainly since the latter part of Q4 in 2014 and certainly for the last few months here in 2015. That is, of course, oil. We've discussed previously that it seems to be the battle lines seem to be shaping up right around the 50 handle. The bulls were excited. They had brought it back up, the March futures over that 50 handle in WTI and others. Then they got clipped again this week back below the 50 handle. So that push and pull, that tug of war, really shaping up right around that strike. And I think once we see it dramatically moving in either direction away from that 50 handle, if it gets into the mid to low 40s again or breaks into the high 50 handle again, we might see some people starting to pile in with enthusiasm in one direction or another. Right now, we've actually seen some of the vol actually coming off a little bit out there as we kind of seem to have pinned, for lack of a better word, around that 50 handle. We'll see if another extreme movement is in our near future, if that will juice some premium back out into these products. Mr. Jared, anything catch your eye in particular from a crude vol perspective over the past week?
So one notable thing is just that crude's it looks like established a kind of a tradable bit of a floor, and so you're starting to see finally a response in the options market, and this is mirroring kind of the base that's also been established in I think energy equities. So you're seeing crude implied vols in the still in the 50s, but not this kind of spiky trend higher action that we've been used to from recent months. So traders who've been chomping at the bit to get in some short vol exposure to crude, this might be the finally the chance where you're not catching a falling knife, but are instead getting opportunity to take advantage of this before the move is done. I mean, some of the moments of this trend have been so sharp, and I know there's been a lot of traders who kind of put on positions fairly aggressively into the end of last year, and really got hammered as implied vol kept rising. The fact that it's stabilized here, both in terms of the commodity finding some price stability and implied vol finding, kind of flatlining at a fairly high level. I think it makes the short vol position much more attractive, especially as fundamentals start to turn a little bit in the sense of all the things that everyone's watching, lower rig counts, demand. One interesting data point that I saw this week was that demand, as indicated by tax receipts in Texas, one of the very few high-frequency indicators of demand for fuel, showed a huge surge in the most recent data. So suggesting that people are finally taking advantage of these lower prices, and that we might start to see, certainly not any kind of rapid reversal, but continued stability, I think, from an option trader's perspective, would by itself make any short vol trade on oil look, in my personal opinion, extremely attractive.
Yeah, and of course, I neglected to mention, we of course saw the much ballyhooed, much bandied about details coming out of the Buffett land. A lot of people out there, of course, following Warren Buffett, and he very famously or infamously this week trimmed substantially. By trim, I mean pretty much closed out his holdings in Exxon, of course, where Buffett goes. A lot of the little fishies follow, so that, of course, exacerbated any downside move you may have seen out there in oil, and, of course, oil-related names and products out there. Is a lot of the retail masses who subscribe to the newsletters that follow Buffett and all the other funds and everything, of course, dutifully dumped their holdings as well. Maybe that's a sign when Buffett gets shaken out that perhaps it's time to start looking at crude, or perhaps, again, you're a big Buffett devotee, in which case you agree wholeheartedly, perhaps, with him. Andrew, I know you guys over at the pit usually focus more on the ETF side, so the USOs, the XLEs and things, looking at the vol out in USO land, which of course is the OVX product. It has been kind of vacillating around that 60 handle for the better part of the past couple of months. It's kind of coming off that a little bit now. It's off about another 1.5 points today, trading right around 54.5 or so today. So a bit south of that 50 handle and getting towards the lower portion of its range for the past few months. months. It hit a low of about 50. And so it's trending towards that level of all else holds steady. So what in particular caught your eye out there in, let's say, USO or XLE land, or perhaps even the big crude options if you care to dabble?
I think the big one I saw, probably one of the biggest piece of paper I've seen in, let's say, in USO, was a vol seller, actually, at the beginning of the week. Selling, basically just selling the farthest out options they could with that had some juice in them. And I think that the timing of that customer was pretty amazing, because he sold about 60 vol, and I think it's down, I mean, I'm going to say 54 vol or something in July, and it's down like 3 or 4 points from there. So the timing was pretty amazing. So I think it feels like oil has kind of found its range here, somewhere around 50. Jared probably knows better, but inflation adjusted, I think that's probably right around the lows or below the lows that we had when oil, tanked into the $20 range in the late 90s. When Clinton was president. I remember we had super low gas prices then with the internet booming. And so I think we're seeing, maybe we see a rehash of all that kind of stuff. Who knows? But right now, at least, I think what's happened, the most significant thing is that the range in the movement in oil has come in. It seems like sort of the arc of the moves keeps tightening up, and the vol is tightening up with it. So, and that's what we're looking at.
Fresh in my memory, wasn't that a strangle out there in USO that we saw earlier this week that you're referring to?
Yep, exactly. It was and they actually sold more calls than puts, I believe. I think it was like the 23.15 in May, and collecting over $1 in premium for it. So, right now they're probably up $1 bajillion on it.
Well, that certainly reflects what we've been saying. Crude seems to be range bound, at least in the near term. And so our friend there putting his money where his mouth is, saying, yeah, it's range bound. Perfect time to be blasting out some straddles, perhaps with a little bit of a call bias. A bit of a risky move, too. Crude could easily break either way, as we've seen many times over the past few months. But our friend there certainly buying into the range bound argument, at least in the near term through March expiration. And before we close up the vol review segment, we know we love our volatility research here on the program. So why we have Jared on here. He's our research major domo here on the old program. And of course, he's knee deep in that straddle study, listeners. So don't worry. Coming soon to a show near you. We'll talk about it here. But before we move on, usually I tend to ignore some of these more shall we say, esoteric, to be charitable types of studies, but this one really caught my eye because it's the high level of ridiculousness, as well as the fact that it's being published in a relatively well-known publication, the American Economic Review. We see a new study coming out. Of course, there's been a lot of talk particularly after October of last year, and the market volatility really cranked up to 11. We saw the cliche Rocktober of fame, or perhaps infamy, last year, and that continued on through all of Q4 into early Q1. Kind of has come off a little bit now, but the early part of Q1 was certainly a rocking portion as well. And so some research into what is causing perhaps this high level of vol that we're seeing in the U.S. equity markets and other markets, of course, commodities and others this year. And of course, according to these researchers, for their study that was published in the February Journal of American Economic Review, they find there might be men causing all of this vol and all of these market bubbles. They did a study. I think I'll use the term study very loosely in this context, which they took market sessions they conducted with different participants, and they broke them down by gender line. So a group of males and then a group of females. It wasn't an enormous study. If I see here, I think it was about 9 people that they did these with. They bought and sold 18 different assets. I'll have to look here and see what the exact number of the article, if you're looking for it, listeners, is called Thar She Blows, Gender Competition and Bubbles in Experimental Asset Markets. Looked at the impact of having a mixed group of male and female traders, as well as women independently and men independently. What they found is that when the women were alone in their market-making sessions, their prices were generally lower, and the volatility in their prices was generally lower when compared to the men. and the men were just off the charts from a vol perspective, from a high price perspective. Everything else that you might guess, they say here, the study's authors, results imply that financial markets might indeed operate differently if women operated them, and they get into some pretty extreme conclusions. They blame men's competitive nature and overconfidence for the collapse of the housing market in 2008, and they note that only about 10% of Wall Street traders are women. Our data suggests that increasing the proportion of women traders might have a dampening effect on the likelihood and magnitude of market bubbles. So there we have it. It's one of these ones that I encourage you to check it out for yourself, listeners. The interesting nature of this one, again, I use that charitably. We usually tend to ignore these types of studies. They're done more to get ink than anything else, and we're certainly talking about it, so we're complicit in that this time. But this one was just so over the top, I had to bring it up here on the show. I know you're a silent co-author for this paper, Jared, so I won't mock you too hard. But what's your take on this notion of it's us, it's men who are the root of the problem? We're the ones causing all these bubbles, all these collapses, and all this vol we're seeing in the marketplace these days.
It's an interesting trend that for the last two occasions that at least I don't know what happened last week, but that I've been on, we've jumped right into social theory on this program.
Well, you got ramped up on some other stuff a couple episodes back. We have a listener mail about that later. We'll get to that in a few minutes.
Oh, okay. Well, I'm not going to form any conclusions, just from hearing the abstract or whatever. But sometimes the methodology of these papers is actually the weakest point. I know there was one I saw recently that was about whether, there's a paper at some point in the last several years about how folks who worked in the financial sector, especially in investments, were more likely to exhibit behavior that you could call sociopathic or something like that.
I did see that one as well. You're right.
And that is like isn't that great? That's that just fits with the stereotype and so on. I work on right now on a trading desk, and it's actually kind of old school in the sense of guys on phones shouting sometimes. You don't see that as much anymore, and it's a lot of fun and really interesting environment. But I don't know if I have any other look, there's not that many women on Wall Street, unfortunately, as in terms of percentage of the rest of society, even in terms of the other industries, as far as I know. And so I think that is unfortunate because just my personal view is that having as many different kinds of people from in as many different categories as you can think of makes things more interesting. Our desk has folks from many different countries and backgrounds from all over the world, and I think that it takes all kinds, and for one thing, whatever views you have about gender relations and men and women, and this actually isn't all that of a clear-cut liberal versus conservative kind of breakdown. I would just mention a lot of second and third wave feminists would really probably take issue with what they would call the essentializing nature of showing sort of women as very, much more passive and caring and adjusted, and men are these aggressive, brutes and so on, is actually a kind of itself a problematic way of approaching the people that we are. So, all that to say, that's a really cute sounding study, and it might be very insightful. I don't know, but I don't think that Wall Street is going to be the place that reveals some deep truth about social relations.
Perhaps not. And of course, Andrew, you and I both cut our proverbial teeth in the trading pits, so we kind of went whole hog into that environment very early. I kind of wonder if there may be a corollary to this study where rather than just men versus women, I think maybe they should study perhaps that unique breed of man that is drawn to that environment, because having spent a lot of time down there, and I'm sure you probably concur as well, it's certainly a unique breed of individual that chooses to go down into that maelstrom, into that chaos, to make their living, indeed make their fortune. So perhaps there's a selective component, and that of course spills over into people on the Wall Street trading floors and others as well. There's probably a selective component of society that chooses to go into that anyway, maybe a little bit more aggressive, outwardly outwardly, maybe a little bit more, whatever you want, whatever other attributes you want to assign to that. So maybe there's more research to be done rather than just breaking it down on pure gender stereotype lines. What do you say to that, Mr. Rock Lobster? You've been on a few trading floors in your day.
That study, is the stupidest thing I've ever heard.
Hey, someone's got to keep these academics employed, sir.
Well, the thing is, we actually wrote profiles when I was working for, a larger trading company, a certain type of profile of a person. And basically, you kind of want a whack job as a trader because it's not a normal job. It's not a normal person job.
It's not.
Have somebody that's not afraid of risk. It has somebody who can analyze things, but they're not afraid to take. It's just a certain type of person. It's a certain type of brain. And I saw women on the trading floor, and they could act just as, because their brains were already slanted that way, as as the guys that were down there. So there weren't a ton of them, but that doesn't mean they didn't act a whole lot different, because it attracts a certain type of person. So I think as far as a gender stereotype, I'm not buying that at all. But, but do women balance the checkbooks at home? Sure. Maybe, in kind of old school marriages and stuff like that. Yeah, maybe they're the one that actually has the risk control in mind. So I think if you think about it, would they be more apt for some risk control? Probably, right? Because they have to do it in real life anyway. But just to, look at 9 people, I just think trading is a certain mental type. And I think that easily could be a male or a female. Before I go into the broad generalizations about, who balances the checkbook and, keeps the house running. But we'll save that for another show.
Yes, let me, before I do any other disservices to these studies authors, I'm not sure about the number of participants. I think that may have been the asset class they looked at 9, so don't hold me to that 9. They may have had more. Hopefully they had more participants in this study. Either way, it is certainly, at the very least, some grist for debate, if not really the most meaty of studies. Still interesting stuff. I encourage you, if you're interested, or perhaps just outraged like Andrew, check it out for yourself, and you could fuel that fire internally. Speaking of fueling that fire, it's time for you guys to do just that. It's time to open up some volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Review. Like the man said, this is the portion of the show where you guys take over. The inmates run the asylum, if you will. Not that we're much better here on the old panel. We got a bunch of questions. First off, you mentioned, Jared, your bit of a social screed on the episode a few weeks ago. Well, we have the man responsible for that, Uncle Ben. He wrote in, I mentioned it last week, but I wanted to make sure you heard it as well. He wrote in after last week's show, and he said, thanks for answering my question last week. This is, of course, he of Uncle Ben name fame. Your sympathy for my plight as the, quote, lone market participant is appreciated, Jared. Sorry I set off Jared's racism detector with my handle. I didn't mean to derail the program. It just happens to be my name that he puts in parentheses, although I do like the rice. So there you go, Jared. It was all incidental. He didn't mean to light a fire under you.
So I'm glad to know that. I don't believe it for a second. I think this is just a ploy by the corrupt institutions. And no, I don't. It's fine. Yeah, this is no problem, Uncle Ben. Thanks for your question.
There you go. On the topic of questions that seemed like they were written purposely for you, Jared, we had someone writing in. Where is it here? Oh, Brian. Brian T. He writes, you guys said earnings is a crapshoot, on a recent episode, so you simply shouldn't play the game. I say that if you take a systematic, risk-limited, short volatility approach, such as with iron condors, that's why I thought of you, Jared, you maximize the potential to harvest premium while eliminating, bit of a spelling error, I think I meant eliminating here, the risk of what Mark referred to as, quote, big blowouts. I did indeed refer to them as that. He goes on to write, you clearly have to be judicious with your strike selection, but I found this to be a profitable long-term approach to earnings season. This one came in last week, Jared. I wanted to hold it off for you because as someone who spent many of his early years in this business until very recently running a business called Condor Options, you may have some familiarity with this approach he's discussing. What do you have to say to our friend here, Mr. Brian T., who's a devotee of the short iron condor going into earnings?
Yeah, that's an interesting question. I appreciate it. Two things come to mind right away. The first is that one of the biggest problems or challenges for putting on that type of spread is that you're paying, because it's risk defined, in exchange for that limited amount of risk, you're giving away a pretty substantial portion of whatever excess premium, whatever potential alpha there might conceivably be priced into the market in the form of buying that downside put. So, and arguably in some cases into earnings, with some stocks that have a history of spiking up sharply as well as down, you can even get, skew on the upside. Sometimes you get it on both ends and you end up paying really elevated skew ahead of earnings for the sake of a defined amount of risk. And if there was depending on pricing for this bet, I would probably be willing to make a pretty big bet that the anytime sort of systematic monthly return from selling condors on a given set of underlyings would actually be much better than selling a condor ahead of earnings for that same set of underlyings. Just because, the skew effects that make condors fine, but something to think about on any given day, I think are more pronounced ahead of earnings. Like I say, especially stocks that move in either direction historically. And so I think it's a really important factor to think about in terms of pricing a spread in those kind of situations. And the second thing is just that I think his intuition there is right, that if you can cap your risk and find something that looks tolerable, then that might be a better way to go than selling a strangle, selling a straddle. Although, honestly, if you think about where the edge is coming from on that trade, if you've done your homework on the underlying such that you have some kind of informed view that the stock's not likely to move more than this amount and the market's priced underpricing or overpricing that, then I think that's really where your edge comes from. Whether it's a strangle or a condor or some other kind of spread is a little bit more about capital budgeting and risk management, which are not unimportant, but aren't going to make or break the strategy over the long run. I think that's what I said before we talked about this. I just, it's really important to get the structure right. But I think in terms of long-term excess return, it's going to come from some knowledge of the underlying asset, I think, more than just happening to get, the right strike prices or something like that in place.
Yeah, that's something I think a lot of our listeners forget. They think about these types of strategies and they're used to the typical investment skew approach that we see in most of the broad equity and index products. They're used to paying a bit of a premium to the downside to hedge on the downside with the put, but probably not so much for the call. But you're right, Jared, in these earnings environments, those are the few environments where you probably might see that call have a decent hefty premium to it. Certainly in some of these very iron condor happy names that people like to trade in, like the Apples and the Facebooks and the big heavy retail names going into earnings. People love to gobble up those calls. So you may be, to hedge that risk limited type spread, you're going to be giving up a lot more than you probably normally would be in the rest of the cycle. So certainly something to keep in mind in that scenario. Andrew, I know you guys talk about condors and iron flies a lot over there in the pit as well. What's your take on our friend Mr. Bryan's short iron condor approach to earnings?
I think the key is you have to have more of those types of positions spread out with less volume. So, you're selling 5 lot here, 5 lot here, 5 lot there, because some of them are going to blow up. I don't care how judicious you are, they're going to blow up. And the idea is if you spread enough of them around with small enough volume, but you have a much better shot of being successful. at that type of trade. And that's really the only type of earnings premium sales that I've heard that's actually worked. And in general, what you end up with is probably a decent but not outrageous return on capital if you're able to diversify, maybe through 20 to 30 to 40 names per cycle. So if you can do it on that scale, that's fine. If you've been, kind of picking and choosing and you've been hitting one or hitting two or hitting three, but your capital's at risk, if you lose on one of them, it's only a matter of time before you get taken out. So I'm not going to say, how this Brian T has got it set up. He might have it set up so he sells, 3-4 lots or something like that on, a 2 standard deviation move, and he takes the premium he can get, and he'll probably generate, if he picks the decent names, he'll probably generate a decent return if he could spread it out across enough of them. But I don't see how it works, and I haven't seen it work. As a market maker, I traded probably 200 earnings cycles per quarter. That's 800 a year. And I could tell you on earnings, probably average, I maybe made a little money overall being short options on earnings, given I traded basically 200 cycles 4 times per year. So I don't know if that's obviously that's not enough for an exhaustive academic study, but if I didn't see a lot of market makers doing it huge either. So if there was edge in it, they'd be doing it.
Andrew, do you think you would have had that net return kind of in your estimate would still be positive if you were upstairs or, just on a screen trading?
It's possible because the difference is you could have picked really where you wanted to be short. Generally as a market maker selling juice, you put your quotes up there and you make markets. And, in general, you might be short, 50 or 100 gamma, depending on the name. And it's where that gamma is. I tended to like the reverse position. I like to own some contracts a little more close to the money and sell a few more contracts out of the money on most cycles, mostly just because I think that's sort of how stocks sort of move. They kind of make that move. It pays for your long side, and then every once in a while you'll get zapped on the short side if it moves huge. And that's generally how it worked out for me. So the only benefit I could see from being upstairs is being able to pick exactly, relatively surgically, what you want to sell. And that might have a chance, but I'll just say again, just from observation, it was a game that made some money, but like I said, 200 names spread over 4 quarters per year. That was a pretty diversified approach. And there was never any big, I would say there was never, even if there was a debacle, it would never cost me like more than 2% per name. So I kept the risk of that type of trade very, very low relative to all the other stuff I was doing.
And Andrew, lest you feel forgotten, Jerry got a couple questions here. We do have one. We actually talked about it. Mark and I talked about it last week on the show, but I wanted to get your take on it as well because it pretty much is your approach he's referring to. So the question from Tim Biggs, he wrote, any data on that theta-free approach to earnings? What percentage of decay occurs prior to the event versus post-event, and how does that compare to underlying movement during the period? I believe he's referring to your free juice methodology there, Andrew, where you scoop some gamma, some theta free or low theta type gamma going into the earnings event in the previous couple of weeks, and then you try to get some scalps off before the earnings event. He wants to know if you have any data, anecdotal or otherwise, to back up that approach.
As far as what I have noticed, there's a couple things on this. Is it decays at I'm going to just the ballpark because it's not always the same. Those options are going to decay at about only 20% of their normal rate. So if you buy an option and on expiration day, you paid $1 for it, and on expiration it's going to be worth $0. Generally, when you buy juice, again, this ballpark number, you're going to have about 80% of the value of the option still left on the day before earnings. There's just that juice just does not go away, but it will decay somewhat. Sometimes it gets a little more pumped. Sometimes it sells off. It just depends on the particular name. What I have found that works the best in general, without giving away too much, is the lower volatility names tend to perform better with this strategy, meaning if it's a low vol name normally, relative to, let's say, a Microsoft or an Intel relative to Amazon or Netflix, the volatility of those names tends to hold up very well because the low vol is already low. I mean, where are you going to go from 25 vol, right? In the earnings, how low is it going to go? So I think if you approach it that way, you have a better shot. Approach number 2 is anytime you can move into a time spread for what I will call even vol, where you can buy the earnings month and sell a front month for around the same, there's generally a pretty good edge in that because that front month vol just doesn't hold up. That earnings vol should, but the vol prior does not. So those are, I think, the 2 observations again, and it's on a name by name basis, cycle by cycle, day by day, which looks actually interesting. But those would be my 2. Those are the 2 things I look for. If I can get one or the other, then it might make some sense. If I can't, I just say thank you very much. And the good thing about not being a market maker is you can just look at the name, you don't see anything worth doing, and you just go on to something else.
Yeah, there's no broker there making you do 100 up.
And no, you don't have to live with it. Like it does not become a Roach Motel on your book.
How are they now? But somehow I thought, Andrew, you might have a little bit more satisfying response to that question for our listener there. When I asked Mark last week if you guys had any data on that, his answer was a resounding no. So I somehow thought you might have a little bit more detail. Hope that answers your question there, Mr. Biggs. And if you want to know more, of course, contact Andrew and those guys over there at the pit, and they'll be happy to walk you through it in more detail. Meanwhile, it's time for us to keep on rolling right on into our final segment. It's time for the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, everybody, welcome to the Crystal Ball. This is indeed the portion of the show where we prognosticate wildly and recklessly, and Mark and I kind of came to the conclusion last week that we thought it was pretty much going to be less vol than we were seeing last week, and of course that seems to have worked out so far, at least towards into Friday. All things hold to the close today. We're seeing vol come off. It seems to have a little bit of a resurgence here, hovering around the 15 handle again in the VIX Cash. So we'll see where we close on the day. But Mr. Jared, perhaps we'll start with you. What are you looking at? What are you thinking for the week to come from a vol perspective?
So I mentioned this at the top of the show. Bad data so far this year, bad economic data, and some headlines just went across during the show about like a 4 week or 4 month. I just stepped away extension for Greece, and these kind of things. If the economic data that we've seen that was so bad in December and January turns out to have just been a question of seasonal adjustments and some weather and other kind of one-off things, then that's great. If Greece gets an extension, or can, gradually the Eurozone can move toward something like gradual progress, that's also great for, and my whole theme for this year is that real progress in the real economy is not necessarily great for asset prices right now. Over the very long term, the correlation in any given year between change in GDP in the U.S. and change in the S&P 500 is incredibly weak. So it's not like economic growth means higher stock prices. It really just depends on where you are in the economic cycle, what valuations are like, what profit margins, all these kind of other things. And right now, stocks are it's not extreme, but they're certainly not inexpensive in most sectors. And forward earnings are priced pretty richly as far as I can tell. So if we start to see, this is, it might be a little bit where we get some of the volatility this year that folks like me have been calling for, is that if you start to see progress in the Eurozone, if you start to see really strong economic data in the U.S., that makes not just the odds of a Fed hike more likely, it pulls forward the timetable, keeping months like June in play, like I've said. And given the strong dollar, the fact that the U.S. consumer is so strong while the rest of the demand in the rest of the world is weak, I think there's some real opportunity, real possibility for rising equity realized volatility over the next quarter even, amidst very strong and positive economic data and news sentiment. I mean, it's not I hate the phrase, where bad news is good news or good news is bad news, because it's so trite. But this is a kind of a situation where progress in the real economy, progress on risk scenarios around the world could actually make it more likely that conditions get a little bit tighter in the U.S. just because our growth is actually so strong. And if that's the scenario, then it could lead to a more difficult picture for companies that have become so levered to cheap money and to cheap labor, especially. The last thing I'll mention is Walmart announced this week that they're raising wages. I've been kind of calling for that, I think, a little bit ahead of the curve. That's still not a consensus view as far as I can tell, and I might be wrong, and that may be why. But I think we're really starting to see building evidence of a turn in the wage growth trend, and that also could put pressure on company profit margins.
Well said, sir. Mr. Andrew, we turn to you now. What are you prognosticating, and how, if anything, does this 4-month extension for Greece gum up the works for your projections?
I think VIX is 14 or lower next week, and I'm planning on it. Full disclosure. So it'd be great for me if that happens. So, and that's as far as I'm willing to project volatility. That's about it. And I do agree with Jared. Once the rates start to rise, it will get a little woolly. However, we got insane equity valuations in 2000 when interest rates were way higher than they are right now. So I don't know if those things totally go hand in hand, but right now everybody seems to be wedded to the cheap money thing. And every time the cheap money stays, equity prices have been rising. So at some point that will get disconnected. And I agree with Jared, it will be ugly and woolly for a short period of time. But I don't think it's happening next week. So VIX 14 or south.
Seems like we saw an initial flurry of vol. It seems like, I think as people were just digesting the news here in the marketplace, that now seems to be coming off. The rally is extending in most of the major indices, and as you might expect, after that initial flurry of spike of vol in the marketplace is coming back again. VIX Cash settling off the 15 handle again, so we're probably traipsing back down towards the 14.8 level where we started the show. We might even end the show, or end the day, I should say, lower than that, because that seemed to be the one thing that really was leaving any vol in the marketplace. So we might be way south of the 14 handle, or at least down around it by the time we close today. But that, unfortunately, speaking of closing, that's about all the time we have for this episode of Volatility Views. But before we go, as always, let me check in with each of my cohorts here on the old Vol Views panel, see what they have cooking that may interest you. Starting with you, Mr. Jared, what's cooking in the land of BGC Partners?
We're chugging on ahead, doing what we do. I've been focusing lately on a lot of custom work for clients, things that don't necessarily go out for public distribution, and trying to help folks manage risk or achieve certain targeted goals in terms of structuring strategies and finding suitable kinds of strategies, and that's really interesting and rewarding work. Although it doesn't. It's a little bit individualized always, but still keeping an eye on things. We put out some work this year on dispersion ideas and industry level screens and things like that are playing out pretty well. And so certainly keeping an eye on those. I was talking this week about that gap again between global weak demand and strong U.S. demand, and ways to think about stocks to take advantage of that. Looking at single names instead of the focus on VIX and index level stuff, which is something we talk about so much. So getting into the weeds on individual names a little bit, and having some fun at the sector level, and overall just having a great time, tackling fairly challenging problems.
And Mr. Andrew, what's cooking in the land of the pit?
Well, I started my sentence with which I do not like to do, but I did it anyway. We have a webinar on creating income with option strategies. It's actually more of a 3-hour seminar, probably closer to 4. Mark and I will be giving it on exactly actually what that viewer mail was: how to sell options to generate premium, structure trades, and understand where that quote unquote income comes from, and what you have to do to get it. There's always a risk involved, as Jared well knows, which he spends a lot of time probably pricing for people. So that's what the webinar will be. Obviously, it won't be as in-depth maybe as one of Jared's reports, but I think for anybody new to options or wants to understand really what's going on with income-generating strategies, it's a great introduction. Send me a note, Andrew at optionpit.com, and I'll give you another $10 off the price on our website, which I think is already ridiculously underpriced at $147, but I'll throw in another 10 just because you listen to VolViews today.
There you go.
optionpit.com, lay it on me, and I'll be happy to get you the extra discount.
The savings just keep on coming here on
all
Volatility.
Benefits from the Options Insider Radio Network to you, the listeners.
There you go. Hit them up over there at optionpit.com to get your savings. Get them while the getting is good. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions, including all of you guys who weighed in on their Fed wager. We'll get to those on a future show. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.